Welcome back to Talk Tickers, your essential feed for earnings call summarization. Today is Saturday, January 31st, 2026. We are bypassing the noise and going straight to the signal on one of the most critical prints of the quarter.
That's right. Today we're unpacking the bellwether of the alternatives industry, Blackstone, ticker BX. They reported their Q4 and full year 2025 results this past Thursday.
And look, if you really want to understand the health of private markets globally, you don't look at the Fed anymore.
No, you don't even look at the big banks. You look at Blackstone. They are the pulse check for the entire ecosystem.
Absolutely. And straight off the top, we have to talk about the disconnect here. This was just a textbook sell the news event. You have record numbers, you have management talking about escape velocity.
Massive AI exposure.
And the market just, well, it treated it like a contagion.
It was a fascinating divergence. I mean, Blackstone delivered what looked like a flawless report card on paper. But the price action, it told a completely different story.
The stock opened soft and just kept sliding.
Right.
Yeah, it wobbled in the pre-market and then just fell. By the close, shares were down over 2.7%, dropped from around 147% down to just under $143.
And the volume was heavy. That wasn't just retail taking some profits.
Not at all. We saw over 8 million shares trade hands. That's up nearly 80% versus the prior session. That is institutional turnover. That's the smart money looking at a record beat and deciding, you know what? Time to take some chips off the table.
So that's our mission today. We're going to parse why good news wasn't good enough. We'll dig into this whole credit and AI supercycle thesis they're pushing and explain why the market is treating a record quarter with so much caution.
Let's start with the snapshot then. Because if you just look at the headline financials, they absolutely crushed it.
Crushed it is putting it mildly. Let's talk about the metric that actually matters to investors. Distributable earnings, or DE.
Right. And for anyone new to this space, DE isn't your standard GAAP net income. It's the actual cash available to be paid out to shareholders. It strips out all the non-cash mark-to-market accounting noise.
It's the cash register ringing.
Exactly. And on that metric, they came in at $1.75 per share. The street was sitting around $1.54.
So that's a massive 21-cent beat.
A huge beat. That translates to $2.2 billion in distributable earnings for just one quarter, up 3% year over year.
And the quality of that earnings matters too. Let's quickly hit on FRE fee-related earnings, because DE can be lumpy, right? It's got performance fees from asset sales. But FRE?
Yeah.
That's the recurring stuff.
That's the sleep well at night money. And the FRE was rock solid. It hit $1.5 billion for the quarter, or 1.25 per share. That's the baseline. So because of that strength, they declared a dividend of $1.49 per share.
Okay, so yield hunters are happy.
Yeah.
But what really blew my mind and what usually drives the multiple on this stock is the fundraising. The cash hose is just fully on.
It's stunning. Inflows were $71.5 billion in Q4 alone.
Just in one quarter.
Just in one quarter.
Right.
For the full year, they brought in nearly $240 billion, and that pushes their total assets under management, their AUM, to a new record of $1.275 trillion.
That number is just so hard to wrap your head around, $1.275 trillion. It's bigger than the GDP of entire countries.
G20 nations, yeah. And the scary part is they aren't just sitting on it. Capital deployment was $42.2 billion in the quarter. They are putting money to work aggressively.
And yet, the stock dropped nearly 3%. So let's unpack that. Because on the call, the narrative from management was incredibly bullish.
Oh, yeah. They weren't talking about defense at all. It was all offense.
Which brings us to the first major theme, the return of the exit. For the last couple of years, the big knock on private equity was that they could buy stuff, but they couldn't sell anything. Liquidity was dead.
Exactly. When rates shot up, buyers and sellers just couldn't agree on a price, so the M&A and IPO markets froze. But on this call, Blackstone President John Gray used a very specific phrase. He said the deal environment has reached escape velocity.
Which is a cool way of saying we can finally sell our companies.
Precisely. It means the cost of capital has moderated enough that the window is wide open again. And they had the receipts to prove it. Net realizations, that's the cash coming in from selling assets, jumped 59% year over year.
And the crown jewel there was the Medline IPO. We have to talk about this because it was such a test case for the whole industry.
It was the ultimate test case. The largest sponsor-backed IPO in history, $7.2 billion. And in a weak market, a deal that size would have struggled to clear.
But it flew. Shares popped 40% on day one.
That's the signal everyone was waiting for. It validates the marks. There's always this skepticism that PE firms are just marking their own homework. But if you take a company public and the market pays a 40% premium, that proves your internal valuations were actually conservative.
It silences the critics. And Blackstone knows that window is open. They claim they have one of the largest IPO pipelines in history lined up for 2026.
Yeah, they are explicitly positioning this year as a heavy harvesting year. So the shift is from deploying capital to realizing gains. But I think the market skepticism here comes from the execution risk. A pipeline is great.
The cash in the bank is better.
That's the show me aspect. But while the exit environment heats up, the thing that really dominated the call was theme number 2, the AI and infrastructure power play.
This was fascinating. You usually think of Blackstone as, the landlord of office buildings or malls. But on this call, they sounded more like a tech ETF.
And they called the AI revolution a generational opportunity. But notice how they're playing it. This is key. They aren't trying to kick the next NVIDIA.
They're buying the concrete and the copper.
Exactly. The single largest driver of returns for their infrastructure business was QTS Data Centers. They took that company private a few years ago for about $10 billion. At the time, people thought they overpaid.
Now it looks like the trade of the decade.
It's the picks and shovels strategy on steroids. And it's not just the server farms, it's the ecosystem. It's the power generation, the grid modernization. You can have the best AI chips in the world. But if you can't plug them in, they're just paperweights.
And who finances all that construction?
Blackstone Credit. They are financing the physical build-out of the AI economy. Their main infrastructure strategy has done 18% net annually since inception.
18% on infrastructure is just...
It's wild.
Okay.
That's supposed to be the boring asset class.
Boring is beautiful when you have pricing power. And right now, if you have land with a power permit, you can basically name your price.
Which connects perfectly to theme 3, the one that should probably be terrifying traditional banks, the private credit juggernaut.
This is the engine room of the firm right now. Private credit AUM is up to $520 billion. That's up 15% year over year.
Management used this phrase that made me laugh. Farm-to-table finance. It sounds like a hipster restaurant, but it actually explains their model perfectly. They connect their insurance clients, who have these massive piles of cash needing yield, directly to the borrowers. No middleman, no bank capital charges.
Just straight liquidity.
And the big growth area now is investment-grade private credit. That's $130 billion in AUM. They are lending to blue-chip companies, not just risky ones.
And the reason that matters is that public corporate bond spreads are the tightest they've been since 1998. You're not getting much yield there.
Exactly. So Blackstone goes to an insurer and says, we can get you an incremental 180 basis points of yield over the public equivalent. That is a massive number.
Okay, but let's play devil's advocate. There's all this external noise, as Blackstone calls it, about private credit being a bubble, shadow banking.
Right, the hidden risk. Well, management came prepared. They cited their realized losses in direct lending over the last 12 months. Any guess?
It was incredibly low.
11 basis points, 0.11%. I mean, despite all the doom-mongering, their underwriting is holding up.
Okay, so credit's booming, infrastructure's booming. But what about the legacy business? Real estate. Has the bleeding finally stopped there?
According to them, yes. Management explicitly said real estate values are bottoming. They pointed out their values are down about 16% from the peak, while the S&P is up 75%. They see a lot of room to run.
The stat that caught my eye was on the supply side.
This is the real contrarian bull case. Construction starts in logistics and multifamily, their two biggest sectors, have collapsed to 12-year lows.
Because high rates just killed new development.
Exactly, which means in a couple of years, there's going to be a shortage of warehouses and apartments. And if you own the existing assets, you have pricing power. We're already seeing their flagship wealth vehicle, Bright, rebound with an 8.1% net return for the year.
And they are just dominating that wealth channel, claiming a 50% market share of all private wealth revenue across the major alt firms.
It's pure dominance. They're ramping up for their busiest year yet of new product launches in 2026.
Okay, so let's synthesize this. We have an earnings beat, a powerful AI story, a credit machine, a real estate bottom. So why on earth did the stock drop 3%?
You have to respect the valuation. The stock was priced for absolute perfection going into this print. It had already run up a lot.
So a classic case of the market getting a bit ahead of itself.
Precisely. The market had priced in the recovery. Now investors are demanding the conversion. It's one thing to mark up a company's value on your balance sheet. It's another thing to actually sell it, get the cash, and pay it out.
Unrealized gains don't pay dividends.
Exactly. The realization number improved, yes, up 59%, but it's coming off a very low base. The market wants to see a consistent string of exits. They're saying, great quarter, now do it again, but bigger.
And there was that point about fee holidays too, right? This is a bit in the weeds, but it matters.
It does. When they raise these massive new funds, they often give the early investors a fee holiday, so they won't charge management fees for the first few months.
So the AUM number gets this huge boost, but the actual revenue from that new money is backloaded to late 2026 or even 2027.
Right. It creates a bit of an air pocket for the short-term traders.
Okay, so let's get to our favorite segment.
Let's do it.
This is not financial advice. This is where we pitch an outrageous but plausible trade idea based on the call. This is purely hedge fund analyst talk. Do your own diligence.
Hi, I've got one. I'm calling it the transformer arbitrage.
The transformer arbitrage. Okay, I'm
The
listening.
logic is simple. Blackstone explicitly said that power availability is the bottleneck for AI. You can build a data center, but if the local utility can't give you 500 megawatts, you're dead in the water.
So we're not buying utilities. Too slow.
No, we go deeper. We go a basket of microcap real estate companies that own non-glamorous industrial land, specifically located right next to major electrical substations.
You want to buy the dirt next to the power plug.
Exactly. The data center operator trade is crowded. We're buying the land that can be connected to the grid cheaply and quickly. That premium for power-ready land is going to squeeze higher than the chips themselves. A warehouse next to a high-voltage line is no longer a warehouse. It's a gold mine.
I love it. It's a location, voltage play. Okay, what's the short?
The short is easy. Generic Class B suburban office REITs.
Brutal.
Just watch what Blackstone is doing, not just what they're saying. They are pivoting entirely to data, logistics, and housing. If the smartest money in the room is dumping office to buy power grids, you do not want to be holding the bag on some beige office park in a Zoom world.
Long the dirt by the substation. Short the beige office park.
Yeah.
The transformer arbitrage. Love it. Again, not financial advice.
Just a theory.
All right, let's wrap this up. Conclusion. Blackstone delivered a textbook operating beat, massive inflows. But the market sold the news.
The pivot is complete. They've moved from rate shock defense to AI infrastructure offense. The farm-to-table credit machine is humming, and the exit window is finally open.
But the market is firmly in show-me mode. Shareholders need to see the cash register ring on those exits.
It's going to be a fascinating 2026. If they hit those exit targets, the stock will catch up. If that window slams shut again, we could test the lows.
Indeed. That's it for this deep dive on Talk Tickers. Keep your eyes on the ticker.